When it comes to investing, you'll often hear terms like mutual funds and index funds thrown around. But what do they really mean? And more importantly, how can they help you grow your wealth? Let's break it down step by step in simple, easy to understand language. What are mutual funds? A mutual fund is basically a pool of money collected from many investors. That money is then used to buy a mix of assets like stocks, bonds, or other securities. Think of it like this. Imagine you and a group of friends each put 1,000 Indian rupees or $1,000 into a common pot. Together, you now have a large amount to invest in many companies. This allows you to diversify, meaning your money isn't tied to just one stock. A fund manager, usually a financial expert, decides where to invest this pooled money. The goal is to earn the highest possible returns while managing risk. So when you buy units of a mutual fund, you're not buying one company's stock, you're buying a small piece of a professionally managed investment basket. How do mutual funds work? Each mutual fund has a specific goal. Some are designed for growth, some for income, and others for stability. For example, equity funds invest mainly in company shares to earn high returns over time. Debt funds invest in government or corporate bonds, safer but lower returns. Balanced funds mix both, offering a balance between growth and safety. When the companies in your fund make profits, you also earn. This can happen in two ways. Dividends, a share of the profits paid to investors. Capital appreciation, when the value of the fund's investments increases over time. Mutual funds are ideal for people who want professional management and diversification without directly handling each investment themselves. What are index funds? Now let's talk about index funds, one of the most popular types of mutual funds today. An index fund is a mutual fund that doesn't try to beat the market. Instead, it tries to match the performance of a specific market index, like the S&P 500, Nifty 50, or Sensex. For example, if an index fund follows the Nifty 50, it will invest in the same 50 companies in the same proportion as that index. That means there's no active fund manager trying to pick the best stocks. The fund simply mirrors the index. This is called passive investing. How do index funds work? Because index funds are passively managed, the costs are much lower compared to actively managed mutual funds. There's no need to pay a fund manager to analyze or trade frequently. This means lower expense ratios, which can make a big difference in your long-term returns. For example, if an active mutual fund charges 1.5% in annual fees and an index fund charges only 0.2%, that difference compounds over years, leaving you with more money in your pocket. Another big advantage is transparency. Since an index fund simply follows an index, you always know exactly what you're invested in. Mutual funds versus index funds, key differences. Feature mutual fund index fund. Management actively managed by professionals, passively managed tracks an index. Goal to beat market, returns to match market returns. Cost higher expense ratio, lower expense ratio. Risk depends on fund manager's decisions, reflects overall market risk. Returns can outperform or underperform the market, matches the index performance. Ideal for investors seeking expert management, long-term investors preferring simplicity and low cost. Which one should you choose? The answer depends on your goals and comfort level. If you believe in professional fund managers and want someone to actively manage your investments, mutual funds could be a good fit. But if you prefer a simple, low-cost, and long-term strategy, index funds are an excellent choice. Many top investors, including Warren Buffett, have said that index funds are the smartest way for most people to invest. In fact, Buffett himself once said, "A low-cost index fund is the most sensible investment for the great majority of investors." Index funds work best if you're investing for the long run, 5, 10, or even 20 years, and don't want to worry about daily market movements. Both mutual funds and index funds offer great opportunities to grow your wealth, but in different ways. Mutual funds offer flexibility and active management. Index funds offer simplicity and lower costs. If you're just starting your investment journey, index funds are often a great first step. Once you gain experience, you can explore different types of mutual funds to build a balanced portfolio. Remember, investing isn't about timing the market. It's about time in the market. The earlier you start, the more your money can grow through compounding. So start small, stay consistent, and let your money work for you.